How's it going, everyone? Welcome back. Or if this is your first time here, my name is Edgar and this channel is about personal finance, real estate investing, stock market investing, and personal development. So if that is something you want to learn about, make sure you are subscribed. Today we're going to be talking about how you can begin investing in real estate with as little as $100 and maybe even less. Did you know that the most common way people have become millionaires is through real estate? So if you are someone who has a desire to become a millionaire, getting to that point through owning real estate is a great strategy. The reason why real estate is such a great asset is that when you own a piece of property, you get to benefit from appreciating real estate prices, which means you make money in the form of capital gains. But throughout the time you own that property, it will also be producing cash flow in the form of rent, so you also make money there. Plus, real estate is one of the best assets to own when it comes to tax advantages because you get to benefit from things like depreciation, which helps lower the amount of taxes you pay on your rental income. But then you also have something known as a 1031 exchange, which allows an investor to sell one property and use that money to buy another replacement property. And if done correctly, the investor gets to defer any capital gain taxes, and at the end of the day, the less you pay in taxes, the more money you keep in your pocket, and that means you have more money available to invest. However, there are a few downsides to investing in real estate, and by far the biggest is the barriers to entry. Even if you're investing in a single family house that is worth $100,000, you would need about 20% for the down payment. Then you would have closing costs at about 3%, and you also have to consider the cost of any repairs that the property needs in order to be rented out. So if you wanted to invest into a property like this, you would need at least $23,000. Then if you live somewhere that has high real estate prices, you could be looking at over $500,000 for a single family house. So at this point, you would be looking at over $115,000, assuming a down payment of 20% and closing costs of 3%. And we're only talking about single family houses, so if you wanted to invest in a duplex, triplex, fourplex, or commercial property, then you will need a lot more money, and the reality is not everyone has that amount of money sitting around. However, there is a way that new and small investors can benefit from investing in real estate without having to have thousands of dollars, and the way you can do that is investing in real estate through REITs. Now, if you don't know what a REIT is, it stands for Real Estate Investment Trust, and these are companies who own and operate real estate, and many REITs are publicly traded, and that means you can buy and sell REITs just like you would with any other stock. Now, there are some major differences between a normal stock and a REIT, and one of those is that REITs are normally bought because of the income they provide. You see, a normal stock may pay a dividend, but they are not required to, and that is why many stocks don't pay dividends. But when we're talking about REITs, they must pay out a majority of their income to their shareholders. Now, some of these real estate investment trusts generate revenue from mortgages that they issue to homebuyers, but most REITs make their money from the real estate they own, and they can own many different types of property ranging from office buildings and apartment buildings to warehouses, hospitals, shopping centers, and hotels. And even though REITs can own many different types of property, they will typically specialize in one area. For example, there is Simon Property Group who specializes in malls. Then there's Public Storage who specializes in self-storage properties. Next you have Welltower who focuses on healthcare properties. And then there's Avalon Bay Communities who focuses on residential properties. And regardless of what type of property the REIT is invested in, whenever you buy shares of a REIT, you become a partial owner of that REIT, and that means you are entitled to the profits, and you get those profits in the form of a dividend. And this means you can become a small owner in a billion-dollar real estate portfolio, and you get to benefit from their massive scale and take part in the profits, all with as little as $100 and maybe even less. So now that you know what a REIT is and how they work, we can move on to discussing some of the benefits of investing in real estate through a REIT. So the first benefit of investing in REITs is the low barriers to entry, and I mentioned this already at the beginning of the video, but this is important because this is one of the major reasons many people invest in REITs. For example, if you're someone who is young and is barely getting started with investing, then chances are you will not have the resources to go and buy physical property. But if you still want some of your money in real estate, then putting some of your money into REITs would be the perfect solution. Unlike buying physical property, which requires an investor to have several thousands of dollars in cash, you can begin investing in REITs with $100 and sometimes even less. Because now many trading accounts don't have minimums to begin investing, and you can buy a full share of certain REITs with less than $100. So you could theoretically begin investing with a few dollars. Also, there's more and more trading accounts coming out with features that allow you to buy fractional shares. For example, if you wanted to invest in a certain REIT but their stock is trading between $500 and $600, and because you're just getting started with investing, you don't have $500 to buy one full share, you can still invest whatever you have and buy fractional shares. So whether you are a new or small investor, REITs are the perfect way for you to begin investing in real estate with small amounts of money. The second benefit of using REITs as a way to invest in real estate is the easiness to get started. Because REITs are traded on the public stock exchange, all you have to do is log into your brokerage account and you can buy REITs just like you do with any other stock. And if you don't already have an account, you can easily open one by going online and signing up with a broker, and it only takes a few minutes to fill out some basic information, and once you fund your account, you can begin investing. Now this is much easier than having to get qualified for a property, spending time going around and looking for a property that works for you, doing your due diligence, then you have to go through the entire purchase process and deal with the sellers. Now yes, even when you are looking to invest in REITs, you need to do your due diligence to make sure you are investing in the right place, but that is much easier than going out and buying physical real estate. The third benefit of REITs is that they are liquid, and what this means is that you can buy or sell shares in a short period of time, and this is especially true with all the technology that is used for trading. Since brokers have thousands of accounts, they can easily take the shares you sold and turn around and sell them to another buyer even when one person is in New York and the other in San Francisco. Now, if I was talking about the pros and cons of REITs 100 years ago, then liquidity would be a big con because one, REITs did not exist 100 years ago, and also, back then stock owners were recorded on paper and not electronically, so it wouldn't be easy to sell your shares on a moment's notice. Also, the amount of people who invested in stock back then was way less, so you would have a hard time finding a buyer for your stock if you needed to sell quickly. The reason why liquidity is a good thing is that if you go and invest $1,000 into one or more REITs and a month later you need some of the money back for whatever reason, you can't just log into your account, make a few clicks, and you have access to that cash again. Now compare that to investing in physical real estate. If you were to go buy physical property and a month later something in your life changes and you need to sell, not only is it going to cost you a lot of money, but it could take you months before the property sells and you have access to your money again. The fourth benefit of investing in REITs is that there isn't any physical work required. Once you buy a REIT, it does not require any ongoing maintenance or renovations. If you go buy some shares in Simon Property Group, you become a partial owner, but it doesn't mean you're going to get a call in the middle of the night because the roof on one of your properties is leaking. This isn't the case with owning physical real estate because if you buy a fixer-upper, there will be tons of work you will need to do, and you will also have recurring maintenance on that property, which can get pretty involved. Now yes, you do have the option of hiring a contractor to complete any work the property needs instead of doing it yourself, but this is going to be more expensive and you still need to oversee everything and make sure they are doing the work the right way. Then when it comes to finding renters, screening them, collecting rent, and doing all of that, you have the choice of hiring a property manager, but once again that is going to cost you money and you still have to oversee the property manager to make sure they are doing a good job. The next benefit of investing in REITs is the limited liability you have. Say you invested $5,000 into a REIT and then the company goes bankrupt, causing the shares to drop to zero. In this case, the most you can lose is the $5,000 investment. Even though you were an owner in that company, you will not have anyone coming after you for more money because the company didn't have enough to pay their debts. Or say the REIT was involved in a lawsuit, even though you do have a stake in that business, you are protected from the lawsuit, so your personal assets are not at risk. This is not the case when you own physical real estate, because if you have a mortgage that is higher than what the property is worth, then you are on the hook for that difference. Or if the property you own is underinsured and it burns down, then you're going to feel a loss directly and you won't be protected behind a multi-billion-dollar REIT. Now these are the major benefits of investing in real estate through a REIT, but there's also some downsides, and the first one is that they are a paper investment. And what this means is that you don't get anything physical in return for your investment. So if for some reason the REIT was to go bankrupt, then you are at risk of losing everything. On the other hand, whenever you invest in physical real estate, you get the land, any structures on the land, or if you're buying the property for the resources, then you get any timber or minerals on your land. The second downside is the lack of control you have over how the business is run, how the properties are managed, and the share price. Even though you are an owner of that company, when you buy shares in a REIT, you don't have any say in how things are done. Yes, you do have voting rights, but unless you control major amounts of shares, no one will listen to what you have to say. This is probably one of the biggest downsides because the people running the company are doing illegal things like overstating income, or if they are bad leaders who run the company into the ground, then you are the one who ends up losing because now your investment is worth less. Also, you don't have any control over the price movement of the stock. Say the REIT you invested in is doing great, but because a lot of people speculate with stocks, you have prices going up and down for reasons that don't have anything to do with the actual business. You may have invested in a great business, but one day the public fears there's going to be a recession, so everyone starts selling, causing your shares to drop, and for someone who is new to investing, this may cause them to doubt themselves, and if they end up selling too, then they could be losing money. Now this next downside relates to the last one, and it's that emotions can play a role in your investment decisions. For example, let's say you were looking to invest in either equity residential or Avalon Bay communities, and after you did some research, you decided equity residential was a better REIT to invest in. So you invest $5,000 into that REIT, but a week later, equity residential is down and Avalon Bay is up. At this point, you could be second guessing yourself, and there's going to be a bunch of other emotions going on, and it can even get to the point where you sell your equity residential shares and buy Avalon Bay shares, only to realize equity residential is now up and Avalon Bay is down. So you can see how it can get overwhelming and frustrating, especially if you're new to investing. And even though many people invest in REITs for income, it doesn't mean they become immune to the price fluctuations. So that's why you still see irrational behavior when prices drop too much. So now you know what REITs are, and you also know the benefits and downsides of investing in REITs. And in my opinion, the benefits of investing in a REIT far exceed the downsides, especially for people who want to have some real estate investments in their portfolio but do not have the resources to buy physical real estate. So with that being said, this is how you can begin investing in real estate with only $100, and that's going to do it for this video. If you enjoyed watching or you found this information helpful, it would really help out if you like and subscribe. Thanks for watching, and I will see you next time.